In this video, I want to talk about the influence of GDP growth, on stock market trends. The influence, the impacts of GDP growth on stock market influence, on stock market, trends. So in this case, I want to talk about number one, introduction to GDP. GDP is the total value of goods and services produced, within a country over a specific period. The total value of goods and services produced within a country, over a specific period. So it gives you a comprehensive performance of the economy. You could use it to measure the performance of the economy. Number two, why GDP growth matters for stock markets. Why does GDP, gross domestic product, why does it really matter when it comes to stock market investing? So it reflects the overall health of the economy, which influences corporate profitability and investor sentiment and confidence. Generally, whenever they say growing GDP, it indicates a vibrant economy, and a vibrant economy will promote profitability, and profitability will then ginger investor confidence to key into that particular stock, and then the stock price will do well, will rise as a result. So it acts as a barometer for economic expansion or contraction, guiding investment decisions. Whenever there's a growth in GDP, it shows the economy is expanding. Whenever there's a contracting GDP, it shows that the economy is not performing as expected. Number three is positive GDP growth and its impact. Positive GDP growth and its impact. So in this case, you look at stock market trends. So generally, a positive GDP growth would boost investor optimism, leading to a higher demand for equity. As I earlier explained, a rising GDP growth would certainly impact companies. It will drive earning growth, particularly for cyclical sectors like the technology, consumer discretionary, as well as industrial. So a growing GDP would boost profitability, and that's heightened profitability, enhanced profitability would generate investor confidence in the market, and as that happens, you discover that the relevant stocks will then perform very well. And not only that, this sectoral impacts, impact on them. Certain sectors, growth sectors thrive, as consumer spending and corporate investment increases. Financial benefits, from increased borrowing and higher interest rates ties to robust economic activity. Generally, whenever there's individuals and corporations could borrow at a lower interest rate, it will boost spending, consumer spending, and even industrial activities, and that would cause the economy to perform very well. Number four is negative or slow GDP growth. We've just seen what positive GDP growth could entail. We also want to look at the effects of negative or slow GDP growth. In this case, let's look at its impact on stock market trends. So it dampens investor sentiment, often leading to market correction or bearish trend. And it equally signals potential recession, impacting earning and increasing market volatility. Once there's a negative or slow GDP growth, it shows that the economy is not doing well, and it will impact consumer confidence and sentiments, and that would cause increase in market volatility in the markets, and you discover that the sector concerned will really it will impact the sector concerned negatively. So sectors like utilities, like healthcare and consumer staple performs relatively well, in times of economic downturn when GDP has contracted. So growth-oriented stocks, especially in the discretionary and technology sectors, may decline. So all these factors will tend to affect a sector or sectors negatively and positively as well. So number 5 is lagging versus leading indicators. Lagging versus leading indicators. Please like this video and subscribe to this channel if you have not done that. So we have lagging versus leading indicators. So GDP growth is a lagging indicator, reflecting past economic activity. That means that in the case of GDP growth, it's telling us of what really happened in the past. And investors see GDP trends, along with leading indicators like PMI or consumer sentiments for forward, looking insight. So the PMI here is, production. It has to do with the level of production in the economy, and so it indicates, a forward. It gives you an indication of what would hold in the future as it relates to economic performance or the stock market, recovery or activity. Number 6 is historical examples. Historical examples. Example of a strong GDP growth during the late 1990s, tech boom coincides with significant stock market gains. So in the late 90s, there was this strong GDP growth during the technology boom. So another example is the 2008 global financial crisis, which saw negative GDP growth and a steep decline in the stock market. It leads to market downturn. Number 7 is global GDP trend and stock markets. When we talk about GDP, it's not only relevant to a given country. So globally, GDP growth will have a significant impact in the economy as well as in the market, because the stock market, is interrelated with the economy, and so it discusses how global GDP trends, trend affects multinational companies and international stock markets. The correlation between any emerging market GDP growth and then the increased investment opportunities, are worth considering. Generally, in the emerging market, discover that there's this increase in GDP growth, and that certainly leads to increased investment opportunities in emerging markets. And not only that, number 8 is limitation of GDP as a predictor. When we talk about GDP, it has limitations actually, when it comes to predicting the economy and the state of the economy, as well as what is happening or what would happen in the stock markets. So it is somewhat limited. So delayed reporting. In this case, discover that there's delayed reporting of GDP figures. It doesn't really come up, as fast as should be expected. GDP data is often revised and not available in real time. It takes time for the actual figure to come out, and so it does not account for income distribution or sector-specific performance. It simply, it talks about the overall, level of production in services and in product and services. It doesn't really emphasize, sectoral, production from each sector. It lumps up the overall, the overall value of goods and services without making emphasis on any specific sector performance. And this particular, factor, brings a kind of limitation when it comes to GDP growth. See, because not all sectors perform very well. Not all sectors grow, at the same time, and so this particular factor, tends to, bring in a level of limitation and inefficiency when it comes to the use of GDP as a predictor of the economy, and so there's a strong connection between GDP growth and stock market trends, because you need to incorporate GDP analysis into a holistic, a holistic investment strategy. We have to do with incorporating, GDP analysis into the overall mix